get too far.
Yeah.
I'll come back.
So if you don't mind, I'd like to start, and just, if you give me like a 10-second introduction of who you are, what your real estate career looks like, as far as where you are in your timeline. And if you have a specialty, what your specialty is. So I'd like to just get some context from you guys. You go in any order if you want to start
Sure. My
back.
name is Karen Leeds. I've been an agent since 2012, primarily residential.
Okay.
I happen to have a listing that could easily be great for a commercial buyer. I'm listing it.
Sure. You guys keep eating. We're gonna go talk.
I am here. I'm here to learn a little bit more about this world.
Awesome.
I don't know anything about it.
Well, thanks for being here.
Yeah, thank you.
I'm currently an inactive agent. I'm working on my post licensing.
Okay.
I just started working as an assistant with the Integral Commercial Group here, the Williams in-house group here. I should finish up my license here in the next couple of months, and I'll probably work as an agent as well. I have a pretty good understanding. I've done a lot of learning residential, but I don't know a lot about commercial. How any of those skills will even adapt to commercial, so it's a new field for me, just learning something new in 2018.
Well, welcome. Thank you.
I've been an agent since about 2018, first 3 years for commercial, and then joined the Integral Group in June. So learning the commercial and enjoying that aspect of it.
Brian, we're a commercial agent since 2018, Integral Commercial Group, KW Commercial. Adam Nicholas, you probably heard that.
I do.
He's our team leader. We kind of call ourselves generalists, but that's just by survival. I mean, we'll take, but I would say land development, residential lot development
Yeah.
seems to be the big deal
Right.
now. But that's real
Yeah.
applications.
Little everything. That's the way I like it.
Yeah.
Fosterville, been residential for since 2019, just got the commercial this year. Actually just wanted to contract my first office there last week.
Congratulations.
Thank you.
Russell Love, team leader for Russell Love and Company. Foster's actually just come on board with us. I've been in business 25 years. Did some commercial, initially land development in Raleigh, was working in charge for a small farm up there for a little while. And down here, I've been primarily residential, and Foster's seen some really great interest and some talent already in the commercial industry. He's like, hey, you're coming with me today. I said, okay. So anyway, I'm sort of like, I've always been sort of one foot in, one foot out. I do when it comes up, I do it, it's not my main focus, but
Sure.
he's heading that direction, so I guess I think it's.
Gotcha. Awesome.
I'm Taylor Reed. I've been with Keller Williams about a year now, mainly focused on residential.
Okay.
Interested in doing more commercial.
Were you in real estate before the year, or you're
Nope,
a year
brand
in?
new. My
Still the
first-
honeymoon
yep.
phase. Okay,
Yep.
good.
I'm Gary Ellis, been an agent since 2015, started in Oregon, and so been in about 3 years out here. We're in Midland. And know nothing about commercial, so here to give a one-on-one crash course.
Well, good. Good. Thank you.
I'm Crystal Danford. I've been with Keller Williams about 2 years, bi-coastal real estate team. I've had my own company in the past and mostly residential, focusing more and more on luxury. And I've got done some commercial. I've got one listing right now that's land, but not a lot of, mostly land commercial, not buildings and stuff.
Raw
like
land,
that.
that could be a
And,
lot.
right, and I've worked for a couple of years with a commercial agent as an assistant a few years ago, so that's mainly my exposure to it.
Thank you.
Manny, my name's Manny Pacheco. I've been an agent for just a few months. I just recently joined bi-coastal. So I have no real experience in the commercial world other than on the VC side.
Right.
I have a business that I manage, so
Residential income leasing or commercial leasing?
commercial. So, but I'm very interested in what you guys have to say.
Thank you.
I'm Kim Crouch. I'm in residential real estate. I've had my license for 2 years and have been active in sales for about a year. I come from a background in finance and accounting
Okay.
and have been a director director of finance for a real estate developer and worked closely with developers as a commercial lender many years ago. So I'm just kind of.
You know the underwriting side of things. Yeah, we do that a lot. We pretend we're underwriters. Our lender friends don't like that so much. We do it anyway.
Yeah, I'm just curious to see what I can do with it on this side.
Yeah, awesome. Well, thanks everyone for sharing. That gives me a little bit of context because, and I'm glad I did, because this is the first time I've had a number of people, more than one or two, that had at least some commercial experience in here. So I'll return the favor whether you like it or not. So my name is Brent Edgerton. I'm a managing director of KW Commercial. I am, just like you, licensed with one particular market center, which happens to be in Greenville, South Carolina. But I'm the rare traveling road broker, and we'll get into a lot of what we do day to day. You talk about being generalists. I say that all the time. We're generalists. There's no kind of, that I can find, there's no category of commercial transaction that we haven't done multiple times. We may have learned by default and how not to do it, but we've done it multiple times. So all the way from, just traditional buyer sellers, landlord tenant transactions to business brokerage with no real estate involved and everything in between. I'll get into this a little bit later too, but one reason I travel so much is I do what I call corporate service real estate, which is basically that my group acts as the real estate department for small to mid-sized companies that don't want the SG&A of a real estate department. So we handle all that minutia for them, really to have a front row seat to the transactional side. When we get to the end of this, I'll tell you how that kind of wealth building can happen and how you can layer things. I've been in real estate as a licensee since December of 2004. Before that, I had a whole nother lifetime in corporate America, mostly in the textile business. I took the golden parachute out of that as soon as I could, as soon as they gave me a chance to, just in time to get into the recession of real estate. So I have great timing, as you can tell. So I've been through it, but I started a company exactly the way you shouldn't. I did get lucky in that timing. I started a company in downtown Greenville in December of 2004, not understanding what kind of boom we were in, right? I just I've dabbled as a developer. I've dabbled in real estate. I think I'm pretty good at selling stuff. Why don't I marry the two? I bought all the stuff inside a mortgage brokerage company office who had lost everybody after the last refi boom right before that. So I wrote a check for the horrible computers and the horrible printer and the fake plants and the nasty paintings on the wall and all of that, and sat down like the dog without the car, caught the car. What do you do with it now? I had no agents, no real networks in that area. I hadn't lived there long. That's not the right way to do it, I assure you, but I did get lucky in that one timing aspect that obviously 2005 up till now was, of course, the best real estate year known to man. Who lived through that? Has anybody ever been in real estate that long? So 05, so the first boom, we all know. So you could fall out of bed and make money in 2005, and I thought I was a genius, and I learned how smart I was about February of 08. We all did, right?
Absolutely.
Yeah, so I've been through it, but the firm that I started, I ended up growing that to about 45 agents in downtown Greenville. And in 2011, I was kind of just, I was ready to do something else, just about. Obviously, we all were that lived through that. And KW called on me, and I had stiff armed them probably for 3 or 4 years. And KW Commercial had just come into being maybe 9 or 10 months before that from Austin as a national brand. And so they came to me and said, look, you're doing mostly commercial anyway. We'll take all this overhead off your hands. We'll pay you a little bit of money on top of that, and we'll take good care of your agents. Keep in mind, I had out of 45 agents, probably 42 of them were strictly residential. So I've lived through what most of you in the room have lived through on a daily basis before, where I was a residential owner and broker in charge. I just happened to choose to go the commercial route personally whenever I could. But I sold everything during the recession: houses, warehouses, cars, children, whatever, whatever I could. So I am kind of the rare commercial broker that has been on the front line, both good and bad, of the residential world. So I do feel like I know what you deal with on a daily basis. I still do the occasional residential transaction, by the way, under the radar. If I have a commercial client that says, I want to buy that $700,000 house right there, then sure, we do that. Why not? But we are not residential practitioners. What you'll find, a lot of what I'll talk about is the differences between residential and commercial. One of those differences is commercial travels. I wouldn't dream of being a residential agent trying to sell from Greenville to Wilmington, just showing up, asking listed agents to let me in houses. That would make no sense, because your business on a day-to-day basis, and I'm talking to the residential practitioners right now, is literally street by street, right? School district by school district. Commercial business, for the most part, is not that way, which is one reason that I travel all over the country. I was on a plane 2 weeks ago to Nebraska for a corporate service client. So quite frankly, a Dollar General, as Brian and these guys will tell you, a Dollar General in Omaha, Nebraska is really no different than a Dollar General in Wilmington, North Carolina, as far as how you underwrite, right? So that's one big difference. With that, Greg, you want to start that? So we're going to, and let me also, as we go to the first slide, let me tell you what you're not going to be able to do after the day if you don't already have commercial experience. This is not to teach you how to be a commercial broker. It'd be silly to think we can do that in the hour or so that we've allotted for this. What it is, it's a couple things depending on who you are and where you are in your career. It's to see, one, if you have an interest in taking your vocation down this path. Does what we talked about today kind of light a fire for you that, hey, I need to learn more about this? So part of what we do, by the way, I say I'm a managing director, I'm licensed with a particular market center. I get referrals from something like a dozen market centers in the Carolinas on a weekly basis. So that's the other thing, we travel as commercial brokers, or at least my group does, but we also cross market center lines, because most market centers don't have the presence that you have here between Greg and Brian and all these guys on the teams already integrated into the systems. It's fairly rare. I mean, there's 3 market centers in Columbia, South Carolina that I passed through today that I work with. There's not one KW commercial member in the lot. So what you won't be able to do is be a commercial expert unless you were already when you walked in. We're gonna just really just scratch the surface of some terms. The second reason you're here is if you're a residential agent and you don't really think you want to go to the commercial route, is to learn how to make money by getting through that cocktail hour conversation or that elevator speech on how to convert those referrals. I mean, you guys, you're in luxury, right? You're putting CEOs and VPs and CFOs in your car. We want to make sure that you have the right buzzwords and lingo and a little bit of just at least sophomoric understanding of the commercial world that they feel comfortable giving you the referral so that you can then take it to a KW commercial, if that's not what you want to work yourself. Right. So that's mainly what we're doing today. There's not going to be, we're not going to get deep into a bunch of ratios of, cash on cash basis versus IRR. We're not going to do a lot of that today. That'd be more commercial 102 or 201. This is really to talk about, again, the differences, which I've outlined here, the main differences, because that's the question I get every time. What's the real difference between residential and commercial? Well, there's several answers to that. So we're going to go through that. We're going to go through a little bit of underwriting stuff. We're going to, the most basic of all basic ratios and analysis is cap rate analysis. We're going to go get into a little bit of that. And then at the end, we're going to talk about a couple more advanced subjects like 1031 exchange, opportunity zones, all those things. But this is not meant to be a lecture. So please stop me if you see something on the slide that you don't understand or that you've had experience with directly, or you just want me to explain further, okay? So it's a free-flowing dialogue, we hope, or we're going to be out of here in a big hurry. So these are the main differences. Timelines, as you might guess, are different. Commercial, residential, on average, our timeline to the finish line is a lot longer. Emotion versus data, to me, that's the biggest difference that we'll talk about. Contracts look different, and there's as many contracts as there are brokerages, I assure you, and some. As far as formats, inspections and the process around inspections are different. Financing, of course, different. Compensation can be different. Unfortunately, it looks a lot like residential these days. That's eroded over the years. So with that, we'll go forward. So timelines. So it can be as short as, I mean, I put 30 days to a year, but the spectrum's a lot even more different than that. I've done it as quick as 4 days and as long as, I think my record is 17 months being under contract before for something that actually closed. I've actually been on contract with something that didn't close longer. So if I had to put an average, because everybody wants to kind of quantify things. So if I had to quantify it, our average, out of our team, our average transaction is about 90 to 110 days.
As long as you held a listing.
Yeah, I think
They always said like.
it's still going.
Still going.
We need a meter up here. I have one listing that's gaining dust by the second. We're going on about 5 years. But there's reasons for that. And that one reason is they've literally been holding at a price that it's now probably worth. 5 years ago, it was worth half of that. So sometimes there's good reasons. I don't like holding long listings either. And I don't like pricing stuff out of the market. Sometimes there's reasons to do it.
Well, I know in residential, I've been, one of the past when I was learning, they encourage you not to, because then you look like an
Yes.
agent that doesn't know how to price things.
That's right. And there is a risk of that. That is one thing that's similar. You do run the risk of being stigmatized as something's wrong with the property. But in the case that I'm describing, we knew certain things were going to happen on properties adjacent to it. And it was just a matter of time. Then COVID hit and
It's more
then,
like you're looking ahead.
yeah. So, and it's raw land. So it's not like it's a building that's just sitting there rotting away.
And it was under contract, right?
Well, he asked me what the longest listing.
Oh.
I had.
I'm sorry.
Yeah.
I was thinking, all right, so the contract.
Yeah, so I had one under contract that closed for 17 months.
Right, the rezoning, all kinds of stuff.
Yeah, and then I had one under contract that was almost what, 20 months
Yeah.
that actually ended up falling through after all.
So Brett, does it help to have an older brother that has a salary that you can borrow from?
Yes. Startup capital is one of the slides. Yes. The nest egg. You can't hide money.
Well, I was always told.
Not the case anymore.
When I got out of textiles and got into this in 1979, I was told that the most successful commercial brokers that specialize in commercial have a spouse with a full-time job. So it was-
Well, and by the way, that's why he ain't got all that play money. He's sitting here as the ugliest administrative assistant in the entire world. So,
Hey, I had Mallory set up, so you messed that up.
yeah, my bad.
Yeah.
But to your point, let's talk about that for a second. What is the commercial broker, and I don't want to speak for the Wilmington market too much, Greg and Brian and everybody else, but I'm speaking for my home market, which is the upstate of South Carolina, but I can tell you it's the case in Columbia, it's the case in Charleston too. What is the commercial broker? And you're not gonna hurt my feelings. What does the commercial broker look like? When you think commercial broker, what do you picture in your head? Physically, it's okay. It's not an insult, it's a fact. Not a trick question.
Older guy playing golf.
That could be one. That could be one. But the more common is the young guy who maybe didn't make such great school grades in college. All their friends went to Wall Street or Financial America or to be exec somewhere where they're going to nice offices with marble tile on the floor at Collins, and they want to dress up every day because they don't want their buddies leave them behind. But they didn't really have the grades for that. They didn't have the resume for that. They didn't have the experience for that. So what can you do and still achieve those things? You can go be a commercial broker and not make any money for 2 years. That's what you can do. So
And those guys have a chip on their shoulder.
absolutely, because as my dad says, they were born on third base and thought they hit triple, usually, right? So that's one of the differences we're going to get to. Greg, you can go ahead and go to the next slide. You know, you can't, we're going to get the compensation slide. I'm probably skipping ahead, but as Brian will tell you, Greg will tell you, Dennis will tell you, it's a long time to the finish line, not just transactionally, but as a career path too. It can be. Some people, hit the lottery right away and have the right networks. You already got a shopping center contract. That's an awesome start. You're way ahead of the curve. But, people that come to work for me, I tell them, look, it could take, we're going to try to get you on path in 90 to 180 days, but it could take 2 years, I'm not trying to scare your folks.
Residential is about 3 months to 6 months.
Yeah, so we're a lot longer to that. And so the reason that I say that, the trust fund babies kind of infiltrate our world, it's kind of a good old boy network, even though they're young. They can afford to do it. So Dennis was kind of talking tongue in cheek, but he's mostly right that it's difficult to monetize. So emotion versus data, again, this is probably the number one thing I tell people if they ask me the difference. So I could only give one answer, it would be that. So I told you I did a lot of residential. I don't have the mentality, the patience, the wherewithal, whatever you want to call it, to deal with a deal blowing up because somebody didn't like the car. I'm not built for that. I learned that very early on. Like I said, I did what I had to do during the recession. But there's a lot of things in this world I would do to make a living before I took a residential listing again, quite frankly. And God bless you, that those of you that are successful with it, God bless you. But I just couldn't take that anymore. When people were getting, during the recession, you're getting 25 to 30% equity day one in the house. But somebody didn't like the carpet or the countertops, that, you know, $3,000 makes that go away. And now you have 23.2% equity and you got the house you want. But I couldn't take that. So not to say there's not emotion in commercial real estate, there is some. And not to say there's not data in residential real estate, there is some. But those are the exceptions, not the rule on both sides. So we deal every day mostly in the numbers and pro formas and underwriting, like I said, whether lenders like it or not. So that's just the way my mind works. That's the way my personality and my patience level works, I guess, because I don't understand people that don't look at the upside of the numbers. Not to say that's right or wrong, it's just the way it is. So that's one thing that checkbox you probably need if you want to be a commercial agent or commercial practitioner, because it's mostly going to be on that side. That's not to say that somebody who built their family business in a warehouse flex space for 50 years isn't going to be sentimental about letting it go or not be unreasonable about what they think it's worth. That part's the same. But there are exceptions. Okay. And again, please stop me as we go. It doesn't have to be on topic necessarily. I think it's something. Just raise your hand when you know. So I alluded to this in the opening outline, but there are just tons of formats of contracts. Out of my office, we happen to use a contract that I stole from Prudential Commercial back in 2006. They made a mistake to give me a Word version. And I evolved it over 10, 15 years. Every time something happened that I just didn't, you know, that's a little fickle language, or it's not black and white, or I'll learn next time not to have that. So I've evolved it as we go. I mean, I evolved it the last time 2 months ago, slightly. And that's what I choose to use. I think it's very straightforward. It's about 11 pages in length. But some of my colleagues will use 17, 19 page contracts. I've seen, I received a contract from a buyer 2 weeks ago that was 2 pages, but it was a commercial contract. I would say the truth's usually in the middle. That's why I kind of stick around 9, 10 pages. It usually covers enough ground. And it's straightforward enough, but also dots all the I's and crosses all the T's. But there's not any, I mean, residential agents in here, you typically use the board contract, right? What they hand you out in the MLS, which is fine because you know you're good and you know who you're presenting it to will understand, right? You don't want to reinvent the wheel. And that makes a lot of sense. But for whatever reason, at least in our markets that I work in, Greg, you and Brian can tell me, Dennis can tell me different, but I don't know how many different contracts you got floating around Greater Wilmington, but in the upstate of South Carolina, Columbia, and Charleston, I can tell you it's as different as the name on brokerage every time. So, which leads to other concerns, like there's pretty much legal review on both sides of the transaction in our world every time. So that's another reason it plays back into the timelines. We're going to start with a letter of intent, which is another point here. We typically start with a letter of intent. So when I first got into commercial real estate, I had hired a commercial broker, which is one of the other 2 that had done commercial or had commercial experience. He came from a big national firm. And first time I met him, he said, well, I'm getting ready to write a letter of intent. I'm like, why are you wasting time with a letter of intent? Just send a contract. Well, I learned very quickly there was a good reason for that, sufficiency, right? If you hand somebody a 11-page contract, they're going to send it to their attorney. Both sides are going to send it to their attorney to review, right? That can take a week, and you haven't even figured out if you're in the right ballpark on price or closing date or deposit or inspection period. So the letter of intent allows you to have a non-binding way to get the outline, the highlights of the terms out of the way. Everybody agrees the letter of intent, then you go to contract that draft. Now you have something to work with. So that adds to our timeline. It could take, it's taken me, I sold a vet practice in the upstate. It took almost 6 weeks to get the contract after we had come to terms on a letter of intent. Because of lawyer involvement, people getting COVID and people traveling, all kinds of stuff.
Does this letter of intent almost works like a pre-negotiation? There's gonna be back and forth?
Well, it is a negotiation, so it's not really pre-negotiation, it's just pre-contract. So a letter of intent is typically non-binding. It won't stand up, it's not work paper, it's printed on to some extent.
It's a discussion.
We can mitigate that by saying, we put it in a standstill provision, is what we call it, where if both sides sign it, you have a kind of a gentleman's or gentlewoman's agreement that you're not going to negotiate with any other party unless you give written notice to the other one that I'm going to do that, or until a certain period of time has passed. In other words, typically we'll say 15 to 21 days. Sometimes we'll tighten it up to 5 to 7 days. And as long as you get a contract to them in that date, in theory, they're not supposed to be negotiating with anyone else. So it protects you a little bit. But truthfully, it's very non-binding, but it saves a lot of time and money. You don't want those meters running on the attorneys on your client's behalf either, only to find out that, they're not gonna accept a penny less than 1.1 million and you've offered 900. Right? So that's the reason. So yes, it's just an outline. And then you take that, extrapolate it into the contract, then you backfill it with the legal verbiage review.
Sort of just skips without using lawyers, offer, counter offer.
Correct.
Same thing, I guess, Brent, with leases, you've got
Yes.
others going on, and you
Same.
might make a fraction of
Yeah.
the commission on the lease, but you're doing the same effort.
It's the same thing. That's exactly right. It's a good point. And so whether we're talking about a purchase transaction or a lease transaction, we almost always start with a letter of intent, unless we already know we kind of have a meeting in the minds, and then we'll go straight to contract and skip it if we know, but that's more rare than starting with the LOI.
So Brent, if you got a buyer in tow, an agency agreement with a buyer, and you're trying to sell a property, or you have a specific property you're going after. It seems like I'm running up on this more often than not. I'll hit a seller that's willing to sell, doesn't have a broker representation, not sophisticated,
Yes.
doesn't have an attorney. In fact, do you have a recommendation for an attorney?
Right.
So I end up, when we have this conversation here, I'm almost in dual agency.
Yeah.
Not quite,
Right.
but I mean, you make them sign the work with the real estate agent agreements.
Right.
Everything. And I like the LOI approach for the very reasons you stated, because then it just sort of lays out a level playing field, and you can understand the metrics, right?
Yeah.
And I'm curious how you navigate when your seller, for example, doesn't have agency representation, and just how you sort of work through that.
So I go to great lengths to get as much as possible in writing, even if it's in an email format, that they understand. I go to the hills with the agency agreements to make sure that they have signed something. Typically, it's people that are not as sophisticated do understand that they've signed something, which is also why an LOI is important. Even though maybe I can't legally hold them to it, I've signed something, so I've got to abide by it. It's kind of the mentality. So it protects, if I don't have broker representation on the seller side, I'm doing it on behalf of the buyer. Also, I will send them a letter of intent, show without numbers or any suggestions in it. And I'll say, we can be the scribe for your wishes, and you can do a reverse letter of intent. Basically, it's RFP, and request for proposals works much in the same way. So sometimes I'll send that to the seller and say, this is what our letter of intent looks like. You tell us what you want to put on it. Sometimes I've been successful doing that without the buyer making an actual offer. Or if I know that the buyer offer is not going to be well received, I may let the seller go first sometimes. The other step I'll take from a compensation standpoint is we'll do what we call have you ever used a one-time showing agreement?
I have none.
It may be called something else. You may have seen it as something else. We call it a one-time showing agreement where they sign and say, if John Doe buys this property, then the seller understands they will compensate KW Commercial at X%. of the purchase price. So it doesn't put a purchase price in there. It says, if you agree to sell to John Doe, who is my client. And that document also makes it very clear that my client is the buyer, and not the seller.
That's like when you're dealing with a FISBO, you want to make sure.
Same
that the
thing.
Seller, yeah.
Same thing, same thing.
Agree to compensate.
Same thing, but the general answer, Brian, is I just go to the nth degree to get as much as they'll allow in writing that they understand that I can't advise them as their fiduciary. But we'll act as a scribe because we need something in writing, and they're not gonna do it. Right?
And I didn't say in that case, but that one case I was saying that my buyer didn't want me to be an agency with the seller.
Right.
They were okay with dual agency quote, but not, they didn't necessarily want me to go have that seller sign.
But even in dual agency, you have a fiduciary to the seller too. Yeah, so you gotta treat the seller as a customer. Unless there are rare occasions where I may know a seller who's not on the market, and I know a buyer that would buy what he doesn't have on the market. And I need to put those two together, and I have done dual agency in that case where I know both, and I don't have either one of them under agreement yet. I'll choose sometimes to do dual agency, and in South Carolina, we can do transaction brokerage too, which is kind of a catch-all in between. Where you just have fiduciary for that one transaction. Yeah. That's very new. That's only about 2 years old in South.
Say that again.
Transaction brokerage. So basically what you're saying is I'm representing one side or both in this one transaction only. And if this doesn't transact, they have no obligation to me to buy something else. If they buy something else, I'm not.
I don't like that. I think all of those are covered in our contracts. in our agreements.
Yeah, but I think in North Carolina, transaction broker, or at least with your board.
Yeah, there's paragraphs that you can add them on.
Okay. Yeah.
You copy it.
Yeah, and that's another way to do it if it's allowed in your market. So. Any other questions about contracts and the lack of format is what I would say. There's not really a going format in most markets.
So obviously having a lawyer that specializes in commercial real estate is great.
Oh, yeah.
You're gonna have everything for you.
Oh, yeah. And some of the lawyers you're using to close will also be on the commercial side, but there is a difference. I actually probably should add that to this presentation. There is a difference you'll find. Now, if it's a basic land transaction, like we're talking about vacant land, any real estate closing attorney, title agent can handle that. But if there's a lot to it where, you know, a developer's getting a new Alta survey, there's just a lot of nuances that people that specialize in commercial real estate law understand it. The ones that specialize in residential law. So you gotta be careful about that. But some can do, some do both. I have some attorneys that are equally good, but educated for both. So the inspection period and the inspection process plays into the longer timelines too. So I get asked this question, it's probably the top 3 or 4 that I get asked is how do you do inspections in commercial? Who do I call? I've got this commercial deal on a office building. Who do I get to inspect it? Well, in most of the markets I work with, there's a shortage of quote unquote commercial building inspectors. I don't know what you guys are doing here, but it's rare to find someone that calls themselves a commercial contracting inspector. So, right, you know, you could probably call 100 residential home inspection companies right now. I wouldn't call them for commercial unless they have the resume. So what I typically do is I build as many relationships as I can with GCs that have done work for me or my clients before. And I basically call in favors whenever necessary, whenever possible. Or I'll get the GC to go do a cursory inspection, but more importantly, they will get their subs for each category to go in. So, in other words, if it's a big enough deal, we'll have an electrician in there. We'll have a commercial, emphasis on commercial plumber in there. We'll have a separate roof inspection. That is the biggest trouble point, as these guys will tell you, in any commercial deal, any building any size is the roof. That's the biggest potential pitfall for as far as inspections go for something falling through. So that's usually a separate inspection because most GCs don't really usually handle roofing. They let roofing guys handle that.
Roofing can cost more than the building itself.
Yeah, exactly.
That's the-
I mean, I had a listing that was a little over 200,000 square feet. And to redo the whole roof was $1.2 million.
You're better off just scrapping the building and rebuilding.
Maybe. With today's prices, you never know, but. Yeah, so that's how we do it. It's kind of a piecemeal process usually. And it takes a little bit longer, maybe. Ironically, it may not cost as much for company tankers, but that's just how we choose to do it. Any questions about that?
So is the buyer paying for those inspections?
Yeah, if there's a
Just like-
cost, if that part is the same.
Yeah.
Yeah, it's customary for the buyer. Now, sometimes the seller will have done it as part of their process for marketing properties that, hey, we have inspections. We've made some improvements lately. Here's what we haven't improved, but maybe we're willing to with the right offer. That happens sometimes, but typically the buyer will pay their own experts to come out and we'll facilitate that. So this slide is actually a little bit antiquated. Probably should change these LTV numbers, but you guys are still used to, I guess, on average, if anyone's buying the average house value in Greater Wilmington, I'm guessing they're still getting FHA a lot of the time, 95% to 97%, so 96.5%. Is that still accurate on the residential side?
That's what I'm saying.
Yeah. So most of the time, if you're in the average price range, you're not going to get that on commercial. You probably already know that before you walked in. But it does fluctuate much more often. Like that answer has not changed in the entire time I've been in real estate on the residential side. It's always been 95 to 97% on average. That's 17 years, but that hasn't changed. This changes every 2 to 4 years as to what a lender is willing to lend you as loan to value. So raw land, when I wrote this slide a few years ago, probably, you were at 65% loan to value on average. Well, I've got lenders telling me now, on the right piece of land, even if you haven't recorded a plan with them yet, do you have some semblance of a business plan of what you're going to do with the land? You could get up to 80 or 85% on some raw land, which I never thought I would see that. And then if you're an owner occupant, I see easily getting 85%. I've seen as high as 90. And I've even had a couple that's got up to 95 by using a primary lender and secondary lender supplemental for development. Now that's owner occupant stuff. So I have a business. Here's my business plan to expand. It includes new real estate. Lenders eat that up as well. They love owner occupants, especially if they're so that can fluctuate even more than what I have on that screen, depending on the situation. Rates are still very good, just as an update of the day. I'm seeing rates I've never thought I'd see in commercial deals, especially for owner occupants. Owner occupants can get 3.25 on commercial. I've seen a little bit lower than that actually, but on average, owner occupants get 3.25, 3.45. And even CRE deals, which is more like buying a Dollar General, which is mailbox money. I mean, if anybody's getting quoted more than 4 3/8, there's probably an issue. I mean, it's just, it's really a good time to borrow money. People are borrowing money that just don't need.
What are the amortization of most of those loans?
It's a good question. It is different. There's hardly every 30-year AMs, although again, I've seen some SBA does that for owner occupants. SBA is a whole nother thing, in my opinion. If you get into a deal and the buyer says they're going to use SBA, run the other way because it's a nightmare. Usually, as you might imagine, and they have onerous prepayment. You don't get out of prepayment penalty ever with SBA. You owe them every bit of interest they would have made. If you pay it, if you refi it, you sell it, whatever. That's a tangent, sorry. I really love SBA, as you can tell. But the amortization, to answer your question, Brian, so we're seeing the average is still a 20-year AM with usually a 5-year fixed, basically what you would know as an ARM. So you have a fixed rate for up to 5, but it's amortized on 20. However, something else I thought I would never see recently, we're getting a lot of 25-year AMs that really helps cash flow. Between the low interest rates and higher AMs, your ratio income coming off the tenant, if it's a CRE deal, versus what you're paying the bank. There's a crazy margin there right now because of those names.
I'm getting a lot of calls, more calls now. And like the last 6 months from bankers wanting to know specifically what's going on with the property, i.e. entitlement, about wetlands, floodplains,
Yeah,
did it
right,
flood during
right.
floods? They have it's like they have a form, and they want to know that kind of information.
Yeah.
So we're prepared, a lot of it's infill, particularly New Hampshire.
Right.
So we're prepared to answer those questions, or in some cases, we'll reach out to the bank.
Yeah.
And just share that information.
Well, people are falling all over themselves to lend money is the general update. And the other thing about lending in our world is I can't have enough relationships with lenders, quite frankly. In residential, it's a lot more form fitting, and there's only so much. That there's 3 or 4 lenders, and they're going to look pretty much the same as to what they can provide. Usually there's going to be slight differences here and there. If I have a relationship with less than 10 lenders at a time, I get a little nervous. And the reason is that every time the loan committee for a specific bank meets, which is usually every month, but especially every quarter, when they figure out how they're going to change things categorically, it's really as simple as this. If First South Bank says, well, it looks like as of last quarter, we're way out of ratio on multifamily. Well, they're going to shut down every multifamily deal they have. They're going to take loan outs for multifamily. However, second generation bank, they had the opposite conversation at the loan committee meeting. So I've got to hop over here with the multifamily deal I have. And that changes all the time. They change their strategy like we change stocks. I mean, it's actually ridiculous. And it's literally just a balancing act of not being, it's diversification of their portfolio of loans. That's all it is. So we have to have a lot more lenders on speed dial than you would in the residential world.
Are they usually, so like you call a lender up, let's say you had that multifamily unit, you call the lender, he's immediately gonna say, we're not doing this right.
Yes.
Another conversation.
Absolutely. That way you're not wasting time. And so it's our job to know that kind of ahead of time, but sometimes we have those very conversations and lenders now, we know business is good right now because lenders are inviting me to go somewhere. I couldn't find them in 2010. They were in the witness protection program. Now they're calling me, hey, let's go to happy hour. But every time I sit down with them, every time I meet them, no matter how well I know them, I'll say, what are you putting money on the street for right now? Where's your interest lie? And then I know that if I get something the next month or two that's in that category, I'm gonna give them a try and make them literally put their money on their mouths. I mean, it really is quite frankly that simple. You wouldn't think it's that simple, but it is. Yeah. So you just got to keep moving with the times. I'm just going to touch on compensation. I mean, I think a lot of people that haven't been in the commercial world just assume that the compensation is higher on a transactional basis. They are mostly correct, but they're not as correct as they used to be. When I first got into business, I think that I call it the average because obviously we have to be careful how we talk about commissions. They're always negotiable with my disclaimer. But it was rare that I saw a commercial listing agreement that wasn't at 10% when I first got into business. It is now rare that I see that at all at 10%. If it's a really small deal, you can usually get that much compensation rate. People are doing variable rates. We do it sometimes where, okay, if there's another broker involved for the buyer, it's X. And if there is no broker, it's Y. Y is us making more money, but having to work both sides. But it's less than X, right? So we do a lot of that. If we think we're in competition for a listing, it's the right corner where we really want to sign and that kind of thing. And we know we maybe won't have to work as hard to sell it or lease it. So it's eroded the difference between what an average residential transaction would pay and an average commercial transaction. Used to be like this, and now it's more like this. And it also changes with the amounts. Most markets I work in, if you get above $1.25 million, the compensation expected that the seller expects to pay gets lower. Could be as low as 4.9% total if it's a big deal.
So Brent, as a residential specialist, referring to the commercial specialist, if you looked at the amount that the residential specialist and the referral makes from that, like this 6,000, he makes it 25%.
Mhm.
We look at it as a price per hour.
Yeah.
If they're making a ton.
Right.
Versus our price per hour.
Yeah.
Okay. Gotcha.
I like looking at it that way. I remember that.
Yeah.
So,
They're getting $1,000 an hour. We're getting-
yeah,
Because they.
and we'll still, I mean, to your point, all kidding aside, we're still working the same amount to make less than we did 5 or 6 years ago.
Maybe they have a 20-minute referral.
And that's the same. That's correct. That's correct.
Okay. Good.
Yeah. The reason I put the lease commission in here, because everybody always wants to ask that, how do you get paid on a lease? We do a ton of leases. I mean, probably 35% of our revenue is off lease revenue. So I'll give you a quick example. We'll move on. So real simple, if it's 5 years at 40,000 a year, now that's base rent, by the way. You don't usually get paid on if the tenant's paying the landlord back for taxes, insurance, culinary maintenance, but base rent is $40,000 a year in this example. 5 years, that's $200,000. It's basically the equivalent of you selling a $200,000 house, and then it's just a matter of what percentage is on the deal. In this case, I use 3%, just to keep it simple.
You
So
get
it's
paid
6,000.
upfront on that, or is it amortized over?
So
Thank you, Brent.
in our markets, yes, you're welcome. Thank you. In our markets, yes, it's typically the language is either upon occupancy or upon a lease signing. And the natural reaction by landlords is, wait a minute, I'm paying you in full. What if they don't stay? That used to be less of a question for some reason, but lately that's propped up its head more often. And so the mitigating answer to that is, first of all, we don't want to take the little, anybody Seinfeld fan? Remember the little residual checks that Jerry was getting from Japan? You know, that's kind of what, if you take the $6,000 over 60 months, that's crazy, right?
Yeah.
So we usually lobby against that very hard, and we make sure if we're on the landlord side, it's in our leasing agreement that we're going to get paid upon lease ratification or upon deposit rendering or upon occupancy. Sometimes that's the same thing, sometimes not. The mitigating factor I've seen lately being the last 2 or 3 years, is a lot more brokers are putting in the deal that if the tenant walks away early, if they default, or if they just try to buy out the lease at a discount or whatever, they owe back the unamortized compensation to the brokers, to the landlord, on top of what they have.
The tenant.
The tenant.
Okay.
So you still gotta go sue the tenant though. If they're in default, they're not even paying the rent. They're not, of course, not gonna pay the commission back. So you still gotta sue them, but you add that to what you get.
At least the owner then feel like I have a legal recourse.
That's right.
From someone.
That's exactly
And I'm not just out.
So if that objection comes up, that's usually how it's satisfied.
But you still get your money up front.
Yes.
Yeah.
Yeah, I get my.
Yeah, you can deal with all that later. Get my money today.
And look, I have worked with landlords before. Sometimes the landlord's in a bad spot and it's kind of a stress situation. I'm working with one right now where we're subleasing a retail building. It was a Badcock furniture franchisee. Things just didn't go well. He vacated the building. He's got 7+ years left on his lease at $12,000 a month. Basically $1 million he's got out there. And he's not gonna pay it unless we bring him a subtenant. And so in his case, I'm working with him a little bit. We've got one subtenant take half the building. He's gonna pay us in 2 halves. So he's gonna pay us some this year, some next year. So we'll work in certain instances, but typically we get it up front.
Is there a normal like restaurant lease, like just a small restaurant or coffee shop or something, like what the term is, 5 years, 10 years? And it's probably no normal, but.
Well, it does differ by category. Typically on a retail lease, you could usually get more, like 7 to 10 years. My childcare group signs a 15-year initial term on a corporate guaranteed lease, which makes them more attractive to investors because they want good landlords. But if you're going into a strip center, for example, probably like what you have in your contract, my investors would want a 7-year term. They get it. They might take 5 for the right tenant. Office leases tend to come down lower, especially small ones, small users, independent mom and pops that just need 1,200 square feet. A lot of times you'll see those being 3 years. Some of them will try to negotiate 1 with 3 1-year extensions. And that does happen. So it's the whole spectrum, but it depends to be, it's usually similar by categories, what I tell you. Retail and industrial seems to get the highest term.
Big retail, right? Not mom and pop retail.
No, but sometimes, we've been successful getting 5 to 7 years from mom and pops. Like, take a liquor store, for example, they're typically just mom and pops. Well, we got one sign a 7-year lease now, if they know they want to be in that particular location. But it is more rare mom and pops, yes.
When I've had only a couple in my career, but where there's a 10-year lease, they only paid me because of a questionable tenant, they only paid me, it was 5 to 10 year lease, they only paid me the first 2 years. And at the end of that second year, they paid me the rest.
Yeah. Not preferable on our side, obviously, but yeah, sometimes you gotta do it. You know, their argument is bring me a better tenant and I'll pay you, right? So I mentioned we've done everything with the exception of the last one. So you see the basic that you expect: buyers, sellers, tenants, landlords, business brokers, what I mentioned. Now that is a little different. You gotta put in your time to understand business brokers. That's not something I recommend for someone that hasn't done it more than once or been on the sideline to watch it done. But that's true underwriting. When there's no real estate in tow, right? And we do that for some reason. Greg just got a business listing in Myrtle Beach for a canvas and awning company. I mean, who would have thought that? And all you're doing is inheriting the lease if you buy it. You're inheriting the location, but you don't own the location, you don't own the brick and mortar. You inherit that lease that's in the hand. That's where the lease becomes very important. And of course, their net operating income or EBITDA, whatever you're looking at for your ratios. So you gotta be careful with this, but we do it a lot. And so we can help anybody in this room that's interested in that, take it down that path. What we haven't done is property management, because I'm gonna tell you right now, if anybody in this room has ever done it or tried to do it, you said you're doing a little bit of it, it sounds like.
No, I was on the other end of it,
Okay,
working with them.
gotcha. So property management is very systems driven, it's very accounting driven. You gotta have a very strong back office system to make property management work. It's not as easy as the tenant calls and says, I need a plumber. It's not that easy. And in fact, in commercial property management, typically the plumber is on the tenant anyway.
And the AC.
But it's, I mean, there's a lot of, having your own trust account and all that, it gets a little really hairy. So these last two, I'd be very careful, and we don't even, I had designs on doing that one time. It's not the best use of my time. You gotta have a really big critical mass of property management to make it worth it, is what I would tell you. You pretty much gotta do just that every day to make enough money to make it make sense with the headaches. I agree. Different kinds of leases, I get asked this a ton too. So I'll hit them quick, but if you have a question, we'll backfill it. But triple net means that on top of my base rent as a tenant, I'm also paying the insurance on the building, property casualty insurance. Separate from that, by the way, you have to have liability insurance in most leases, just about every lease. But property and casualty, whether you pay for it or the landlord pays for it, you're still paying for it because you're reimbursing the landlord under a triple net lease. Tax bill, it can either be sent to the tenant or the landlord will pay it and you owe the landlord back for the amount of the taxes. That's all negotiation and logistics, but on a triple net lease, the tenant is paying for all that stuff. Okay. Gross lease is obviously the opposite. Also can be known in office buildings as full service lease, which actually takes that to another level. But it means that when I write a check to my landlord every month, I don't owe them anything else. That's it, unless there's late fees or something like that. Modified gross can be any combination of these two put together. So it could be that the tenant's paying insurance but not taxes, or the reverse of that. Or in an office building in full service, sometimes it's not separately metered by suite because the original building was built for one user, and now there's 4 users in there, and they don't want to pay to have 4 separate meters. So everybody just splits up the utilities by square footage used. So modified gross, if you see modified gross, you got several follow-up questions you have to ask to figure out what the tenant's really responsible for. Does that make sense? And again, we go back to the compensation of leases, you're basically getting paid on this amount. What they're paying you on a triple net basis. All right, so there's tons of measurements, and if you go just do a quick Google search, you can find a million ways to analyze and underwrite a deal. We're not going to talk about those today, except a little bit. We're gonna talk about a cap rate, which is a form of net present value, by the way. And I'll mention right now that the difference between the cap rate and ROI is simply the ROI includes debt coverage. In other words, you're paying your mortgage lender. Cap rate ignores that, and I'll explain that. We're gonna flesh out cap rate a little bit, because this is one of those buzzwords and terms that if you have even a basic understanding of it, someone will trust you with that referral. Okay. So it is nothing more than a measure of risk versus reward or return. That's what a cap rate is. So the higher the risk, what do you think is involved with a cap rate? Higher the return. Higher the cap rate, right? So the lower the cap rate, the lower the risk, the opposite. So they have a direct relationship. Okay.
Now, Brett,
Mhm.
that's,
Yes.
you say the lower the cap rate, so let's say it's a 5% versus an 8.
So if you're an investor
Yeah.
and you're getting a 5% cap rate, you better be just completely sure that the tenant's not going to default.
That's right.
Meaning,
Because you're paying more, your higher price based on the net income.
because you're expecting that you're going to collect all your money and you don't have any risk to worry about.
So I thought it was a bit more risk, lower cap rate.
No. The risk is, so I'm gonna give you an example. I'm gonna give you the CVS example after this slide, and that'll bring it home for you, I think. But the calculation is this simple. Your total investment going in. Some people use price. That's not right. Let's talk about, let's say you're replacing a roof and you're buying something for $200,000 and the roof is $40,000. You figure cap rate on the 240, not the 200 you pay to plug. If you have a short-term capital investment that needs to be made, upfit or whatever, that needs to be your total investment before you figure out the cap rates. Okay, so it's your total investment as a purchaser, okay, divided by your net operating income. Net operating income is just as simple as it sounds. You take your gross rent that you're getting paid and you subtract all your expenses. Now, it's a little bit more complicated than that in the sense that, let's say that you think you need a roof in 12 years. You may take the cost of that roof and amortize it over 12 years as an expense. Basically, you're accruing for it, right? Because you know what's going to happen. You may accrue that. Also, vacancy is another expense. So if you think you have if it's a multi-tenant building and you think I'm going to figure in 10% vacancy, that's an expense that should be figured before you get to your net operating. But other than that, it's just straight subtraction problem. Does that make sense so far? So if I'm getting a net operating income of $24,000 on a $240,000 investment, that's obviously 0.1, which is a 10% cap rate. So what does that really mean? In round terms, it means I'm getting my investment back in 10 years. As long as I made $24,000 or more in NOI over that time as an average. So it's really not that complicated. The reason I call it the barometer, okay, so does anybody know why we don't figure debt coverage and cap rate? Why would you think that is? I need the financial writer to speak up. Everybody's financing terms are different. How many different ways that's how you can finance a property if you notice that? Yours is going to be different than his. And it may be by choice. It may be that you want to put 50% down and he wants to put 20% down. Well, I can't tell you what your real return, your ROI is going to be, unless I know exactly what you're financing. And that's when you figure ROI.
You said you get your investment back in 10 years. So is that equity in initially?
Yes, because part of that 240 was whatever you put down.
So that's what you're actually measuring is the over 10 years, right?
That's right. Well, that's right. It's just a net present value formula, which you saw in the on my list. It's just cap rate is a form of net present value with a discount factor. The discount factor in this case is 10%. That's all it is.
It could have been 20% plus 40.
It can be whatever.
Yeah.
This just happens to be a 10% example because I wanted the math to work out that way.
Okay.
Right. So if it was $30,000 and your cap rate is higher, I'm not smart enough to do that math, but it's higher than that. Right.
Mm-hmm.
If it was $12,000, it'd be a 5% cap rate. Instead, if it was 12 instead of 24, you're getting a 5% cap rate. It's really as simple as that. So The reason I call it the barometer again is it equalizes every investor and every investment. So if you're looking at a Dollar General in Wilmington and you're looking at a Family Dollar in Raleigh, you can compare those two investments by using a cap rate. It cuts out all the noise. Now, you might say Dollar General has a slightly better credit rating than Dollar General, so I need, or the reverse of that would actually be true. Dollar General has a little bit better credit rating than Family Dollar. So you could self-underwrite and say, instead of a 10% cap, which wouldn't be the case in that example, but instead of a 10% cap, I need 11% cap because Family Dollar is a higher risk than Dollar General. And you'll see that as trends in the market. When I analyze investments for clients, I pretty much know that if I see a Dollar General, so the average cap rate for a Dollar General right now, just to quantify an example for you, is probably about 7.25% to 7.45% cap rate. Okay. And that's a secondary market sale. It's not, you didn't build the building for Dollar General. You're buying it from the person that did. So let's say that they burned 8 years off the lease for Dollar General the investor has. They fully depreciate it, which is usually what happens. They usually depreciate it fully by the 8th year. Then you'll see a bunch of them come up for sale. And if it was a 15-year lease, there's 7 years left. If I see a 9% cap rate on Dollar General, what would be my guess?
From CBS.
Depreciation is gone.
Depreciation is gone, which is why they're selling it, but why are they giving me such a high cap rate? Because there's less term left on the lease, therefore the risk went up. If I've only got 7 years left and I get a 9% cap rate, I've got 63% of my investment back. If Dollar General leaves, you have an empty special purpose metal building that without the Dollar General sign on it is worth a fraction of what you had invested in it when you bought it in the secondary market, because what you were buying was the income of Dollar General. That makes sense?
Yeah.
So Greg, go to the next slide. All right, so Dennis, to the CVS example. So I think this will bring it home for everybody as far as the risk versus reward. So CVS is up to, I haven't looked in the past few years, but at the time I wrote the slide, they had, I don't know, something like 40,000 stores.
Yep.
And so CVS strategy is that they can build it cheaper than you can. So they can buy the dirt, same price you can buy it probably. Maybe less because they're coming in cash and closing in 15 days if they really want it. Especially if Walgreens is on the other corner. They'll do whatever. And vice versa. Most ridiculous thing I've ever seen. But so they'll overpay for the dirt, but then they're going to build it with their construction crew that works for CVS and CVS only in travel country, a lot less than you can build it for. Okay. The week before they get a certificate of occupancy, what do you think they do next? What do they sell it? How do they sell it? What do they have in tow with the sale? Like what makes it worth it?
They have a lease.
The lease. So they sign a lease with themselves for 20 years. What do you think the cap rate is on a 20-year CVS lease? That, by the way, the reason it's relevant to have 40,000 stores, CVS is not franchised. In other words, you're not underwriting a CVS franchisee that could easily fail. You're underwriting a CVS corporate because they're all corporate stores. So when they sign a lease, they're signing on behalf of CVS corporate. It means they got to go bankrupt on everything before they stop paying you your lease. Even if they go dark on the store, which happens. If you see an empty CVS and the lease isn't over, they're still paying what they're supposed to pay, whether they're using it or not. So what does that do to the risk? Down to nothing, right?
Almost no risk. You're gonna get all your return back over 20 years.
So on 20-year, well, what's cap rate? 5. So what they're doing, they're gonna get it to where they'll pay enough lease to get it to where they can sell it to you at a 5% cap rate. And so what's your upside? You're gonna say, well, why would I do that for 5%? Doesn't count leverage, but it doesn't count your debt. So you actually have spent more, even with tax shelter, than you've gotten back. But why would you do it? 2 reasons. You're betting that they're going to stay more than 20 years. They usually stay more, at least 5 out of 10. Okay. But if that doesn't happen, you're betting that you got, let's just pretend for a second, which cap rate does, that you bought it for cash. You got all your money back. Now you have an empty box that isn't worth so much, but it's worth something. That's all bottom line money. So if you can sell a CVS building for say even $400,000 when you're done, then you made your money back, plus you made 400 grand, plus you had the tax shelter, of what you paid on the debt.
So that's a good long-term investment.
Yes, and it is long-term. That is not a short-term play.
Yeah.
All right, now. And I use 6.5%. That was really for a secondary market sale. You, just like Dollar General, you can buy CVS's after it's been depreciated, but then you've only got 8 to 12 years left on the lease. Okay, so those even are trading at 6.5% or so. So you're taking a risk that you're not getting your money back. They don't renew, and you better get enough on that empty box or release it to a mom and pop. Take a higher risk. You do that. The same building. Same corner, same traffic light, same town, it's still a pharmacy, but it's Jim and Jan's corner pharmacy now, it's not CVS. So what does that do to cap rate?
That's good.
Does that make sense? Well, it's good if they follow through. The problem is if Jim and Jan don't, you're gonna take their bass boat, maybe. Really? Are you gonna chase, you're gonna take their house, you're gonna take, I mean, it's not the same process, right? They don't have the wherewithal, if they default, to make good. Well, then you gotta release. And all that costs money.
But we've got an example of that here.
Yeah.
We've got Walgreens and CVS on another corner. And used to be, was it Rite Aid up here?
Yeah, most of those.
Sales for 2 or 3 years. Of course, if you can find I don't know if you know, but if you can find a wild religious group, and they're really taking good offering.
Well, Halloween Express.
Yeah. Spirit.
We had one in Greenville, a Rite Aid that turned into, it's actually the best wine store.
Yeah.
In Greenville. So you never know what somebody can repurpose, but it's still, there was a lot of time to get to that point once Rite Aid was gone,
And
right?
they're gonna continue to pay their lease even if the business fails, so you do have 20 years of income.
And they'd have to go chapter 7 or chapter 11 across
As
the
a
country.
quarter, yeah. And here's the thing, so let's say that CVS pulls out because the store's not profitable, they still have to pay you, the store has failed, you still own it. You could either try to sell it to give it to someone else, they're gonna continue to pay you. If they're continuing to pay you on that, can you also lease it again, or? I guess
Depends
they're
on,
locking it up.
depends on the lease.
Gotcha.
Sometimes you're allowed to relet, called reletting, to relet without them getting off the hook at all.
Yeah, that's what I'm thinking.
Sometimes it's just a supplemental deal where they start to pay you the difference. They can do a buyout deal. If you find another tenant, what you could do is say, let's say they owe you $250,000, okay, and with the rest of their term. And you find a tenant that you really like, that's gonna pay you the equivalent of, say, $80,000. You can still get them to buy you out at 200, and you gross 280 instead of the 250 plus 80, made an extra 50 grand. In other words, they'll overpay commensurate, like they'll overlap those two sometimes. That's when you really look out as an investor, honestly. You can play that game. Sometimes you want corporate guarantee people. Bi-Lo's are a good example. Is Bi-Lo over here? The grocery store? So they're obviously huge in South Carolina, or they're nothing now. They've been bought up by Lowe's Foods and Food Line. But they had leases in town that had 15 years left. They were paying every penny of it, and the landlord was just like, whatever. They weren't even marketing the building, they were just sitting there staying. All right, so are we good on, does that help bring cap rate home a little bit as a kind of a general conversation? All right, 1031 exchange. Who can give me the best explanation of the 1031 exchange? Has anybody done the 1031 exchange in the room before?
I was gonna say, that's definitely, we're paying, we're getting our expense
Yeah. So essentially, it is avoiding capital gains. That's how it's known, is that somebody's selling something that's not their primary residence. You hear the term like-kind exchange thrown around a lot. That is a misnomer. People that are fresh to real estate that hear this term, it's a like-kind exchange, they think if you're selling a warehouse, you gotta buy another warehouse. No, it is any real estate transaction that is not your primary residence. You can go to Wrightsville and buy a condo. If it's not your primary residence.
Not where I live.
Yes, exactly.
It's like not my home.
Yeah, exactly. But you can do anything. It doesn't have to just say, oh, it doesn't have to be income generated. It doesn't. You can buy a second home if you want to. So it's really that broad. There are very specific rules. Somebody gets a gold star, they tell me what a QI stands for. Qualified intermediary. So the QI,
And the Q and I part, right?
You're the Q and I.
so the QI basically acts, the way to look at it is they are an agent of the IRS, not an employee of the IRS. It is an independent group that has been vetted by the IRS. And they act like, so just like a title agent acts for the title agent for the title insurance company, right? The QI acts as an agent for the IRS. So the IRS is trusting the QI that that person that is implementing a 1031 exchange has followed the rules. If you get audited and you didn't follow the rules, then the QI is in trouble, and so is the buyer. Kind of like a notary, but to a much higher level.
I've always used alternative QIs, is that,
Yeah, but there's,
I've never used a non.
yeah, so we have a group in the upstate that is not attorneys, and they don't want to be, because they don't want the conflict of interest. So the attorneys just kind of stick to closing and recording deals, and QI stick to what they do. By the way, it's very strangely cheap. So standard QI is making like $1,000 or $1,200 per closing, even if it's a $10 million deal. Kind of crazy, but they're responsible. So one big thing is that when you close, not $1 of those proceeds from the sale, after everybody else is paid off, but not $1 of the other proceeds can go into the seller's pocket. It has to go to the QI's trust account. That's a separate escrow account from the closing attorney. So that's one huge thing. You can't touch the money as a seller. So you have to declare that you're going to perform a 1031 exchange before you close on the property. And you can decide later that you don't really want to buy something. You pay the QI their money, you take the rest of your money, you just make capital gains. You can change your mind. It's just you didn't avoid capital gains.
This is great though, if you're gonna reinvest. Or
Yes, if you know you're going to reinvest anyway.
Can it sit in there? So let's say I have I'm working with somebody that owns property, like, man, I want to get rid of this, but I don't want to buy yet. Can we get a QI, put it in that trust for a year or two while we?
No. No, there's a finite period. So that's part of the other rule. So the rule is this: you have to declare within 45 days of closing 3 properties. And it gets complicated after that. You actually go up to 5, but then there's other rules. If you go to 5, you can't invest more than X% over what you sold if you do that. But at 3, it's unlimited. So the rules are this: 45 days from closing, you have to name 3 properties. That actually gets postmarked and sent by the QI to the IRS. That they're declared to do a 1031 exchange, and they're going to buy 1 or more of these 3 properties. Okay. You then have 135 days from the end of the 45-day period to close on what you're buying. So a total of 180. So you got 6 months. So in your example, your answer to your client, we know you got a total of 6 months tops.
Okay, so when I was doing residential, I had a young lady that had a lot she sold. Said she might want to do a 1031, didn't know, turned around and told the lawyer, no, she just wanted to sell it. So she can't turn around after that's happened and say, oh, wait, I want to do a 1031.
No, because she took the proceeds from closing.
Right,
And once you do, that's over.
okay,
You have 45 days, but only if you declared it before closing.
okay.
Yeah, because it's gotta go into the QI.
Yeah,
Right,
the closing
understood,
attorney.
Right.
And the
She's
QI actually
making
signs,
that up.
the QI actually signs the settlement statement.
Do what now?
The QI actually signs the settlement
Okay,
statement.
all right, so
So
that
they-
would have been something that, because originally it was gonna be 1031, so the lawyer was saying, okay, we have to do something different. So,
You have to get a QI involved, and all that money has to go to the QI.
interesting,
And
okay,
then-
so she's not gonna be able to do it.
No, there's no going back on that. Yeah.
Okay,
What she needs to do is get her accountant to get her cost basis up so that she doesn't have as much capital gains. That's her only recourse now.
okay,
Is decide that she spent a ton of money on that property, so her cost basis was so high that her profit wasn't as high as we thought. That's the only way.
Yeah.
To avoid something.
it was inherited from daddy.
Well, cost basis is important in that case too. Hopefully that was already done before closing.
I mean, doing something like that, that's something you're gonna do, you're pretty much going in, this is what you want, because in reality, you don't have 100 days, you only have 45 days to find the property. And so that's
Yeah.
something that you would be looking for.
But you're no worse
prior to
off.
signing, right?
But here's the thing, you're no worse off if you don't do it, except for whatever you pay the QI. That's the only thing you owe different. You're still gonna pay the same capital gains you would.
So if you are working with someone that wants to reinvest, it's even if they don't find a property, you're still, I mean, you're not paying anymore, you're just going to delay the payment.
You're delaying it until they change their mind and you owe $1,000 to $1,500 to the QI. That's all it costs you.
Yeah.
And then you're gonna be responsible for the capital gains on that sale from that tax year.
Does that capital gains, if it's held in that trust at the end of the year to the next year, does it fall in that financial year?
If you buy in that year, you don't have any capital gains, so it doesn't matter. It washes out your tax responsibility anyway, but let's say that the years cross over, and I don't wanna get too far into the accounting world.
That's not our job.
But if it crosses over, my understanding is that you may have to either refile to show that you really owe capital gains, but you didn't report them. Or you just do it, you adjust the next tax year. It really depends on your accounting.
So is day one of 45 days, the day after they close on the?
Day
original-
one is the day you close.
The day you close, because those are the days you receive those monies.
That's right.
Gotcha.
Now, you could change mine the next day, but you still owe the QI, because they've already done their work, really.
Would you hire that person like before you close?
Yes.
Yeah.
So I put clients with a couple of different QIs, one in particular that's kind of the expert in our home market. And QIs can work anywhere, by the way. They can work anywhere in the country. The QI we work with syndicates deals. He's in syndication too. So like Bank of America building downtown Greenville, he was part of syndication. He put together a syndication group to buy up 200 million. So he works all over the country. And QI is because IRS, this is a federal ordinance, right? A federal tax code thing. You can do it, QI can do it from their desk anywhere in the country. Because it doesn't matter, because the person might be buying something in Florida or New Mexico, or Utah, or wherever, that's fine. It doesn't have to be anywhere in particular, as long as it's in the United States.
So when you find your list of properties on day 46?
Too late. Well, cameras on me.
And it is going out of the building.
I will say I'm not a QI, so I've never waited to postmark something. But let's say some QIs might have in history.
I understand.
Okay.
Can you guys be a broker? Just-
Yeah, as long as they're not involved in the transaction.
Okay.
You can't cross the path of being the broker and the QI. That's too much complication.
I was thinking that guy that syndicated the 200 million.
Yeah, but he didn't do it as a broker. He just did it as, quite frankly, a syndicator. He may or may not at one point have had his broker's license, but I don't think so. He never wanted to do it because of the conflict of interest.
Sure.
200 million, what would be a normal, for $200 million transaction? What would a broker see brokerage company? would see?
Oh. Probably a half, I think.
A little bit offset, but I just want to get.
Yeah, I mean, it obviously decreases with anything in that realm. I wish I knew for sure.
Yeah.
I don't know that one, but yeah, it'd probably be a half point. Usually above 10 million, you see about 1.75% to 2% total. No, total.
Total.
If it's above 10 million, you might see 2% total, 1 and 1 or 1.5, 1.5. There's another question here or something, I think. Now, I do not claim to be the expert in opportunity zone. Okay, I will tell you that I've never on purpose performed an opportunity zone transaction, meaning I think I've sold stuff in opportunity zones before, and I in fact own a small piece of a building in an opportunity zone. But I didn't do it because it was, and the buyers I work with that bought stuff in opportunity zones didn't do it because it was an opportunity zone. This is another way to mitigate capital gains taxes, and possibly some other stuff. But there's a lot of onerous details to it. You basically, to get your full benefit of avoiding capital gains, you have to own it for 10 years. And after the 6th year, you get a piece of it, waived, of your capital gains waived from something else that you owe capital gains on. Does that make sense? So it's kind of a 1031 exchange without the 1031 exchange, except you got to hold it a lot longer to make it work. You can also get, there's a lot of other grants that are cousins of opportunity zone. You've heard of the vacant building tax credit, for example. Building's been vacant for 5 years. You can usually get local property taxes waived for up to 7 or 8 years, or you can choose a 25% income tax credit that can be taken over 5 years. That's a cousin of this.
Really good for property.
But this is like a stepbrother of 1031 exchange. It's a cousin to these other like vacant building tax credits. There's textile mill credits. That's the holy grail. People actually buy all the textile plants And that's the best tax situation I've ever seen, because you get tax credits dollar for dollar for the amount you spend on the property. But not only that, your total investment, what you use to develop the property and invest in that property. Now there's a limit on that. It's typically a $500,000 limit, I think. No, I take that back. The vacant tax building is $500,000. I think there is no limit on the tax credits. So what developers actually do is they'll buy it and they'll sell the tax credits to banking institutions on margins, arbitrage. So let's say the tax credits are worth $1 million, they'll sell it to the bank for $850,000. And they'll use that cash to do what else they do.
Because they get it all at once. So-
Yeah, they get the rights to it, but you can transfer your tax credits to another entity. And you can sell it on the open market. It's like selling bonds, basically. It's just arbitrage. Okay, so I kept you guys a long time. I appreciate you hanging in there. But what did I not cover that you think I should cover? What are some questions you have? Oh, yeah, we added that. That's important. But before I get to that,
That was the next question.
What's that?
That was the next question.
Oh, yeah. Well, so the best way I can, so this is for the residential practitioner that doesn't think they're gonna get into it, or they're just not ready to get into it. I don't need to tell you, there's people you put in the car, there's always a commercial option. You know, they're moving their business here, that's an obvious example, or they're just expanding, they say, yeah, it's crazy at work right now because we just don't have enough space. You know, you're looking for all those hints, but I would just encourage you to blatantly ask them. Like, tell me more about your work life. What does your company do for their real estate? Can you make an introduction? You don't have to go with the introduction. One of us can go with the introduction. You're still gonna get paid. So I would encourage you to be aggressive is the wrong word, but
Inquisitive.
there you go.
And for those
I like
who
that.
wondering who to refer to, integral. I do
Greg's
have-
bigger than you, so careful.
I do have a couple questions. Let's see. So when you're working in commercial, is it very lead, listing driven? Like residential? Are you looking at listings?
Yes, that is a similarity. Yes, and I would still rather be on the tenant or buyer side, much as I was on the residential side. But yes, it is still like, you know, we all call it the lifeblood of real estate lead generation. It still is.
Okay.
Yeah.
And now, I guess the other question would be, I'm looking at this here, and you know, these are ideas for people, like shifting into commercial real estate from residential. Let's say, take someone like me. I'm not working in, you know, real estate. My license will be ready by the end of the year. I'm already working as an assistant. I'll probably start working for them. Where would you send someone who's just going straight into commercial? Where would you tell them to start working? Where would you tell them to start looking for leads and clients?
For leads? Oh, there's not one answer to that. It's a, much like we call ourselves generalists. There is a myriad of answers to that. I get way too many leads in watering holes. It's a fact. It's a fact. I do. But no, all kidding aside, general networking still applies. There's a certain amount of diamond for dollars, you know, lead generation on the phone, but it's getting to the Chamber of Commerce meeting. It's going to what we call tilt-up events where there's a groundbreaking on a commercial project. It is all those things that really, like as I list them, you're gonna say, oh yeah, I knew that. Whether you implement it is something else. And you mainly, just like in residential real estate, you gotta tell everybody to listen what you do, where your passion is. You know, you gotta advertise that new listing on LinkedIn, and Instagram, and Twitter, and everywhere else. You've got to generate.
Yeah, I would say that would be my weakest part, coming into commercial real estate, I'm not from here, and I don't have any kind of background.
Well, you're working on a team.
Yeah,
So if Ryan has a listing, Ryan's not gonna care that you put his listing on Instagram. He's still getting paid.
that's true.
If you bring a buyer, Ryan's certainly not gonna care.
And still.
Right? I shouldn't speak for you, but
No, that's.
I would. And that's part of being a team. So Greg is relatively new too, but he's got 55 listings because he's part of our team. He can advertise any of those. Because again, if it's a CRE deal that we talked about, Dollar General, it doesn't matter where the investor lives. It doesn't matter where the asset is. It matters who wants to buy it's not like you're putting your business there. You're putting your faith in getting income out of it. So it's wide open for that, but it's just general net. There's not a silver bullet answer to your question.
Go to places where people who may be interested in investing.
Follow money.
Follow money. Go hang out those places and meet everybody.
I'm not telling you my word.
Just 'cause he's there, you don't need it.
But you got a pretty good percentage chance it didn't go out anywhere.
Brent, I first got in the market here, what I did was I had no listings.
Yeah.
This is back in '85. And maybe before you were. But anyhow,
No.
but anyhow, what I did was I use this as what I call the 10 recommendments rather than 10 commandments
Yeah.
of Judeo-Christian religion.
Yeah.
We all are involved in some of this. And faith-based communities and stuff, but I call this the 10 recommendments of residential real estate. Is that you adopt a listing in your team or in your company. And you go after that as if it was your listing. Sometimes
Yeah.
the listing agent, now if it's a team concept, you'll get a nice percentage.
Yeah.
If you bring a buyer, you'll have a good percentage already. But if it's a non-team, they may give you 10% to help market.
Yeah.
And then when they sell it or anybody else sells it, you get that. The other thing to do is if you go get the buyer for that $4 million hotel.
Yeah.
That Will has, whatever, and you focus in on that. And it's amazing once you focus in on a particular, and then you learn the business of the hotel business in about 3 weeks.
Yeah.
Really get it in.
Well, what you're saying is you want a frame of reference.
Yeah.
You want to provide the vision for whomever.
Yeah,
Right.
and I did that when I first came back here in 2000. I went on charitable, the 10 commandment thing.
Yeah.
For the faith, I went on it, and I came back here and I started coaching residential firms, and I adopted their commercial
Yeah.
specialist listings and made, 50 grand the first year.
Yeah.
From just adopting their listings and bringing the sellers.
Yeah.
Yeah.
So, and we'll ask one final question, and then I'll quit asking
That's all right.
questions. So you said that you don't work like in one small area of your state. And so you think it's better to, so we're North Carolina agents, should we be?
I wouldn't necessarily say
Or
that's
slowly
something,
expand?
I wouldn't necessarily say that's something to emulate. I'm high on the ADD scale. I have to do something different every day. And so I didn't plan to go do any real estate consultation in Nebraska. I never planned to go to Nebraska in my entire life. If you've ever been to Nebraska. You know. It's no, here's what I say about Nebraska. It is exactly what you think it is. It's no better, no worse. I've never been somewhere that was exactly what I thought it was gonna be. Like, there was no surprises at all. People are nice, but it's exactly what you thought.
I know
But
that traveling doesn't bother me. I would love to travel.
But the answer is you can, because we're going back to the statement I made at the beginning. Commercial travels. Okay, now you gotta be careful about licensing involves. When I go to Nebraska, I go as a consultant, and I make sure there's a broker of record on the back end. But I'm still making 80 or 90%. It's just a reverse deal. But that's an extreme example that I don't want you to think that the broker community just does that out of hand. That's something that we do on our team. It's called corporate service real estate. So I'll give you a couple of quick examples. So I have a child care group. And so 2 of the deals that Greg and I are working on in Wilmington is with this child care group, where we did site selection, found the DERBs for the child care group. They have 140 centers in 8 or 9 states. Okay. They happen to be based out of Greenville, South Carolina. We handle all the minutia of, please call the landlord and tell them the roof's not our responsibility, but he'll give us a new roof. Instead of a 5-year renewal next year, we'll give him a 10-year. And we'll negotiate all that minutia. That makes us exactly $0, less than $0, because the landlord's not going to pay me on a renewal for a tenant he's already had 25 years. He's just not. He's like, you didn't buy me this. You're just getting in my pocket. You're asking for a discount. Why am I going to pay you for a discount for a 10-hour hour? We do that for what reason? To get to the 2 deals, say in Wilmington, where one of them I'll be part of the development team, and the other one I'll just act as the broker probably. And so one of those events can pay me anywhere from $80,000 to $150,000. Well, it doesn't take many of those a year to make that minutia, that landlord relations exercise, which sucks, worth it. Right? So that's one way. I don't know if do we have no slide here?
This is it.
Yeah, so that's one way to layer income as a commercial broker. You can start participating in your deals. There's no saying that in the commercial world that brokers buy the best and sell the rest. That's very much the case. There's a bunch of NAI guys and Colliers people and big national firm people that invest in somewhere around 30% of what they transact. So I've started to get to that level with that group. For example.
Just as a funny side, while you were talking about that, I'm thinking, that's what happened to me in my 51 marriage, the same girl. She made me sleep on the couch 3 years, 8 months, 2 weeks, and 1 hour for a tram. I didn't get paid for that.
It's similar, but I built, if anybody's interested in that, I built a corporate service program. Like the child care company, I actually charge them a retainer every month. That just goes to pay my assistant for her time. They probably not even. But that's just so they're committed to me. I have a behavioral health group that also operates in 8 states. That's why I was on a plane to Nebraska. We're converting a former frat house into a behavioral health home and a former motel into a behavioral health home in Omaha and Lincoln, Nebraska. Well, I'm gonna get, they don't, there's 2 things have in common, there's 2 entities have in common. Neither one of them ever owned